And in the normal times, you would have had it as a sort of a get-together with the members, interacting formally, informally, everything. Anyway, when the budget goes paperless, it's only natural that the workshop goes virtual. We are happy that we are able to do that.
Also, great pleasure for me to welcome our team of experts, Mr. K. Vaitishwaran, Mr. Sriram Seshadri, Arvind Srivatsan, Mr. Vikram Vijayaraghavn, and Dr. M.R. Venkatesh, members of our General Committee, past presidents, and all the members and invitees and attendees who have joined us.
Platform with him. Mr. Vikram Vijayaraghavn is an advocate at Subbaraya Iyer Padmanabhan Ramamani Tax Advocates, one of the oldest tax law firms in South India. He litigates regularly before various judicial forums, including tribunals, high courts, and Supreme Court, and consults for a number of corporates across South India on tax issues. Before pursuing law, Mr. Vikram had an engineering background with 2 masters in computer science and electrical engineering from Stanford University, California, USA, and has worked in successful startups and currently owns a software consulting company, Vulcan Tech Software. With his dual background, Mr. Vikram has, among other things, developed a number of free mobile apps of various acts, which are currently being used by thousands across India. Mr. Vikram serves as the co-chair of the MCCI Direct Tax Committee and has spoken on invitation at a number of conferences. He also serves on the board of a number of companies in South India and is the organizer of the popular K.R. Ramamani National Tax Boot, conducted by the School of Excellence in Law, Tamil Nadu, Dr. Ambedkar Law University. Don't be bowled over by Mr. Vikram's qualification. He has another side. He is a budding Mridangam artist, finding time to learn and practice in his busy schedule.
Thanks a lot. Can I request the Madras Chamber to allow screen share rights? I'd like to, yeah. Can you see my screen? Can you see my screen?
Not yet, Vikram.
Not yet, not yet.
Okay.
Yeah, I think it's coming now.
Perfect. Okay, thank you very much. It's always a pleasure to address the Madras Chamber, and it's a privilege to be in August gathering with so many senior tax and expert professionals here. And so what I'll do is I'll present the direct tax amendments so you can ask them the questions. I am very happy to share the Direct Tax Committee chairmanship with Mr. Arvind and also be guided by Mr. Sriram Seshadri, and also have the privilege of being a colleague of Mr. Vaitishwaran. So let me dive into the details here. What I have done is in this analysis PowerPoint, which I'd be happy to share, I've covered every single clause that is there in the memorandum, every single clause without fail. Obviously, due to time constraints, I would like to focus only on certain important amendments which have been there. In fact, there are quite a few amendments which are deeply impactful in direct taxes. So what I will do is there are around 70 amendments or so, all of which have been covered in this slide, which I'll share, but I'll concentrate on like these 18 amendments, which I feel are the meat of the direct tax changes. Now, before I'm starting, I would like to say that the devil is in the details, and I'd like to spend details making it a purely technical session. And being an advocate, I'll play devil's advocate because I'm not happy with quite a few of these amendments. Now, let's start with what I would say is the biggest change which is there, which is the new reopening regime. See, what happens is, many of you know that reassessment or reopening or income escaping assessment, as it is called, section 147, is kind of the holy grail of tax litigation. What typically happens is there is a 6-year period from the end of the assessment year wherein the department can come back and reopen your assessment. Typically, if there is a scrutiny assessment, obviously it is 4 years, and also there is a further bar on the department to prove that the assessee has fully not disclosed material facts. Now, the whole reopening served as a very important bulwark of saving the assessee from the department coming and in the future essentially reopening various issues and keeping on litigating on that. And how it was saved was the notion of reason to believe. I'm sure I'm preaching to the choir here, but most of you know that this important phrase, reason to believe, in section 147 essentially said the assessing officer can't, by basis of a change of opinion, do a reopening. And so this was a very good safeguard. There has been tremendous jurisprudence, and starting from Kelvinator, going to Forum France, there are any number, there are literally thousands of decisions, starting from the last amendment in 1989 to various small amendments which have been made in section 147. In a sense, Section 147 is kind of the most litigated with respect to assessment procedures. And what is really surprising is when the finance minister made the speech, it was like it was going to be from 6 years, it will be 3 years, and everybody was very happy and rejoicing. And when you look into the details, as they say, the devil is in the details, it was a real shock to see what has happened. What they have really done is essentially throw away the old reopening scheme and come up with their new method. And the memorandum gives an idea of what is happening. It says information is received from other law enforcement agencies. I'll read the highlighted portion. Therefore, assessment or reassessment is information driven. The need to completely reform the system of assessment or reassessment would result in less litigation. I really don't think that is the case, and I'll explain why. What now happens is there is going to be an assessment or reassessment when there is information available. The notion of reason to believe doesn't seem to be there in the section itself. It no longer seems to be codified in the new section itself. Entirely 147 has been replaced with new language. And it says information. And what is that information? Any information which has been flagged in the case of the assessee for the relevant assessment year in accordance with the risk management strategy formulated by the board shall be considered as information. This seems to me a peculiar and wide-ranging assault on the system of reassessment which was there earlier. And it also says specifically, interestingly, to all those who have been doing cases and have been involved in cases, audit objections can't be the cause for reopening. There are any number of judgments, including Supreme Court judgments. There is a specific amendment here which says a final objection raised by the CAG, it shall be considered as information. Further, the search assessments have also been folded into 147. There is no separate search assessment, 153A, BC, etc. Everything has been folded into this umbrella of information. And in case of search, it is deemed that the assessing officer has information which suggests the income has been chargeable to escaped assessment. Now, the one good news is the GK and drive shaft procedure, wherein there will be a notice to be served, and then the assessee will reply, and then the speaking order has to be passed, has found a codification in this new law. But the fact of the matter is there are various other small tweaks which go against decisions which are there. For example, many people would know in the current reassessment scheme, if the assessing officer reopens or reassesses and finds new material or new issues, he usually has to issue notices for each of them. Now, this is called explanation 3 in the current scheme, and that has been done away with by saying that even under this procedure, notwithstanding the procedure prescribed in 148 was not followed, such notice can be issued for reassessment. So all in all, one of the interesting points is it is a complete revamp. It is not like how it came across as a 6-year to 3-year, but it's a complete revamp. The another important point is what about the time limits? The finance minister mentioned 3 years and 10 years in her speech, but the devil is again in the details. It says no notice shall be issued if 3 years have elapsed from the end of the relevant assessment year, and it can be taken only in a few specific cases. Now, what are these few specific cases? In specific cases where the AO has evidence which will reveal income escaping assessment represented in the form of an asset amounts to or is likely to amount to more than 50 lakh rupees. It seems to be a very small amount that can be up to a period of 10 years. So my assessment is, in fact, there will be a lot of reassessments which are essentially 10 years because the 3-year limit to the 10-year limit seems to be an easy bar to cross. Now, the points to ponder here are many, but I would say the biggest takeaway for me is this. You see, there's a very famous statement which says, different is not always better, but the better is always different. Just to be different, they have thrown away the old jurisprudence, the bulwark of jurisprudence of thousands and lakhs of cases which were there, and come up with a completely new scheme which works on information. And that information is going to be vaguely defined, and it will be a rolling stone. I'm very happy with this, and I'm quite sure most of the professionals and auditors will agree with me on the same. Now, what has happened is it's based on risk management strategy from third parties, from search, from audit objections, and really it is going to be a 10-year reopening rather than a 3-year reopening. So all in all, this according to me is the biggest change in this budget, that there's going to be a completely new reopening scheme. Now, let me move on because I have paucity of time. I'd love to discuss various case laws, etc. I don't have the time in this session.
Vikram, if I could just mention.
Absolutely. Please do so.
Yeah, so Vikram, very well summarized. What kind of comes to me as very starking aspect is, on one hand, to drop the timelines for issue of notice to completion of assessment. The whole process of getting your refund, getting your assessment done will happen in 13 months. But then you have a provision which actually goes back, and after you implemented faceless, where you have so much of faith, you have a provision which actually says no. I mean, it can go up to after having faceless, you still have a situation where you can have uncertainty of tax positions going into significant point in time. And again, it kind of makes me understand, having dropped the tax rates down to 25%, 22%, 15%, is there a method that really wants to send a very strong message coming out of not just reassessment, but all there are other provisions as well. It's a clear message. Don't mess with me types. One is we are watching you. We know what is happening, and in case then even if we have a foolproof system, 3 units. So after going through the rigors of this, case will come down. There will be a reduction in the case going on the key. I think it has something slightly reason. The point of risk management strategy, it's one of the background. The risk management strategy, as we all know, is also something which is not known. Today, you don't know on what basis you could get a notice for the assessment. So, if that is going to be used as information or deemed as information that could be used, these are genuine concerns, and these are concerns also from the investor community who need to provide capital because the way they do indemnities depend on the period to which the reassessment or change in assessment position. Over to you, Vikram.
Thank you. So the next one I'd like to focus on is the advance authority ruling. So a lot of cases are with the AAR, pending application with the AAR, so as to essentially determine the taxability of a transaction. Obviously, it applies only to those transactions. Its persuasive value is there. And we have had various different kinds of rulings in the AAR over a period of time. It's both Bombay and Delhi have AAR benches, and the progress of the AAR has been slow. But surprisingly, what has happened with this government in this finance bill is, let me read the memorandum here. As per past experience, the post of the chairman and vice chairman have remained vacant for a long time due to non-availability of eligible persons, and so on and so forth. And therefore, there is a need to look for alternative method. It seems like they are not able to fill the retired judges' post, and hence they have come up with this whole new scheme of a board for advance ruling. They are scrapping the AAR, coming up with the board for advance ruling. Now, the reasoning seems to be a little peculiar, but what is worse is the board for advance ruling is going to have only department officers. There's not going to be any legal judicial person involved in it, essentially from the common taxpayer or from a lawyer perspective. And what would happen essentially, this is a department committee which is going to be deciding issues on taxation. What is worse is usually from the AAR, you file a writ to the High Court. Now what it's going to be is an appealable to the High Court. So to be practical, what is going to happen is assessees are going to approach the AAR. It's going to consist of department officers. It's not going to be binding on the department apparently. And even if they decide against, lo and behold, they decide against the department will go on appeal to the High Court, and it will be log jammed there for quite a while. So the effectiveness of the AAR has been dealt a body blow, according to me. And if I'm not mistaken, the indirect taxes had this notion where advance rulings were from a department officer board, and it was not a pleasant experience there either. So I don't think this is a positive move. This is another retrograde move, according to me. Now, if I may move on to the faceless tribunal, it's one of the other provisions I wanted to focus on. The tribunal has been one of our homes wherein the final as a final fact-finding authority, there has been a lot of cases where the tribunal has stepped in and said that lay down the law, because going to the High Court and litigating in the High Court may take many, many years, in fact, dozens of years in certain cases. So tribunal has been a very effective mechanism overall for solving disputes, and making this faceless seems to be quite a shock to the system, especially with the introduction of a dynamic jurisdiction. Now, the one good thing is this is 2023. By that time, it's going to be notified. But in terms of tax advocacy practice and litigation, this is a major change, and we have to see how this is going to play out. One of the things that was mentioned a little worryingly was, if required, hearing would be given. I don't understand how that, if required, plays into natural justice principles that the tribunal is really built on. But this is another major change which is there by this budget. And settlement commission, just like this government has basically said different is always it's not always better according to me, but they've gone ahead and said settlement commission is not something that we really are interested in, and they're discontinuing the settlement commission. In fact, what they're going to do is the pending applications in the settlement commission are going to be going to an interim board. You can of course choose to withdraw from that pending application and go back to the authority where you were originally supposed to go. But the idea is that the settlement commission itself is going to be wound down from 1st February 2021. In a way, even if you remember, recently there is this case, Abhishek Singhvi versus the CBDT, wherein whether VSV can apply for the settlement commission. And now clearly that was also an amendment which was brought by this budget. Clearly they are not interested in having settlement commission as a dispute resolution mechanism anymore. So there ends the matter with settlement commission. Now, one of the things, now let me go on to the more technical aspects. I spent some time on that. Now, the 194Q was introduced, which is a TDS on purchase of goods. All of you would remember the earlier budget introduced 206C1H, which basically was on the seller. It was a TCS provision. Now there is a TDS provision, and there are some thresholds which are there. The total sales has to be exceeding 10 crores in the financial year immediately preceding the financial year. And then it's a TDS is 0.1%, and aggregate of value should be 50 lakhs in the previous year to the seller. Now, it does not apply, of course, to cases where tax is deductible under any other provision. It has a particular exception, which I wanted to point out. If the TCS is required and as well as TDS is required, then the transaction only under TDS shall be carried out. This is a specific amendment which has been made. Also, if there is no PANs applied, it is 5%, and all these amendments will take place from 1st July 2021. I expect there will be some set of clarifications, but the general move is that purchase of goods also, the government basically is going to get some money very quickly. That's what is going to happen here. The rationale is it's only 0.1%, but every cash flow amount counts. Arvind, you want to say something?
Yes, I think there is a concern. It was there even under 206C. What is the meaning of the term goods, and does it cover software, intangible assets like this? I think that same concern is also imported under 194Q, and there is also a concern it would also cover some specific financial transactions like transactions in unlisted shares. So you know, with the import of this definition of goods, those related provisions and concerns also kind of come in.
Exactly. I think, yeah, the same concerns with 206C, as you pointed out, will start coming here, and we are looking for clarification from the CBDT on this. Now, the next one I'd like to talk about, which is an important one, is the slump sale amendment. What happened essentially is, all of you would remember the slump sale amendment in definition in section 242C basically means a transfer of one or more undertakings as a result of the sale for a lump sum consideration without values being assigned to individual assets. There are a number of important cases on this, Artex manufacturing, etc. Now, the interesting thing here is certain judicial forums have held that a transfer otherwise than a sale, then the provisions of 50B will not apply. And some of the important judgments are Bharat Bijli and Oricon, wherein, for example, they transferred it, business division and against shares, getting shares, and it was considered a slump, not a slump sale, but an exchange. And so 50B would not apply. Now, this was always going to be controversial, and I think that the government quickly came into play here and said, in order to make the intention clear, they amended the definition of slump sale so that all types of transfers as contemplated in 247 will have will flow under slump sale too. And this, one of the important changes with this finance bill is that some of these substantive amendments are actually taking place with effect from assessment year 2021-22. One of these slump sale amendments is such similar, and goodwill is also the same. Right. So this is a technical amendment which was made, fixing overriding certain decisions. As usual, most budgets will override certain judicial decisions, and this budget is nothing new. The next one I would like to focus on is, yes, the transfer of capital asset on dissolution or reconstitution. Well, this has a checkered history. I don't want to belabor too much on it, but a lot of you would remember 45(4). Now, 45(4) basically provides the profits and gains arising from the transfer of capital asset distribution of capital assets on dissolution of a firm or otherwise shall be chargeable to tax as the income of such firm, and the fair market value of the asset in the date of transfer shall be deemed to be the full value of consideration for the purpose of 48. Now, the key phrase is, of course, dissolution or otherwise. And what had happened is, just to give a background for people, of course, is that 45.3 and 45.4 itself came about because of this whole Kartikeya Sarabhai case, and essentially considering the individual assets and the partnership assets as the same. And there were a lot of tax planning, putting individual assets into a partnership and then essentially dissolving the partnership, reconstituting and dissolving the partnership. So 45.3 and 45.4 really date back to that 1987. But then what happened is there are a number of decisions which basically said, in terms of 45.4, the otherwise does not refer to cases such as reconstitution. In fact, one of the interesting things, and we have argued it as well as many others, in Madras, there are a series of decisions such as Vikas Academy, wherein there was a reorganization of the firm and the reconstitution, and that was said that no capital gains will arise under 45.4. And the other trick that a lot of people use essentially is the self-generated assets such as goodwill would be used to reevaluate the capital account, and then there will be an excess of credit in the capital account, and again this used to be escaping capital gains tax. So what the this finance bill basically did was change 45.4 to specifically say dissolution or reconstitution. I have highlighted the word here. So it is now very clear that this otherwise will not we can't escape with the otherwise here, as well as introduce a 45.4a, which basically says that the excess of balance in the capital account in the books of account shall also be subject to capital gains. And it's interesting to note the proviso, which basically says the balance in the books of accounts will be calculated without taking into account any self-generated goodwill or self-generated asset in terms of the revaluation. So I think this has essentially plugged the hole that was brought about by these various judicial decisions, especially by the Madras High Court. And the other one, which is important on a technical aspect, is, I think, goodwill. This, I think, I'm quite sure has been a hot topic of debate. Goodwill depreciation, the difference between the amount paid for the business and the net worth is, of course, treated as goodwill, as you all know. And Smith Securities was a landmark decision which essentially said goodwill was an intangible asset which is entitled to depreciation in light of explanation 3B to section 32(1). Now, this has been pretty controversial. In fact, there are tribunal rulings post Smith saying that goodwill is not a depreciable asset and giving reasons for the same. But the fact of the matter is there has been a lot of favorable rulings since then, and this has been the accepted norm. Now, the budget clearly proposes the goodwill of a business or profession will not be considered a depreciable asset, and there would not be any depreciation on goodwill of a business or profession in any situation. And they have made a number of amendments to the Act to make this effective, which is going to the term goodwill, section 211B, which defines and clearly said that it will be expressly stating not being goodwill of business or profession, going to 32 and making sure that they are saying not being goodwill in business or profession. Interestingly, section 50, it is amended to provide that in a case where goodwill formed part of a block of asset for the assessment year beginning 1st April 2020, depreciation has been obtained by the assessee. The WDV and the short-term capital gains shall be determined in the manner prescribed. And this is a little controversial, so it will impact ongoing transactions. And 55(2)A has also been modified to specifically address this. All these amendments, just like the lump sale amendments, are going to take effect from 1st April 2021 and apply for 2021 assessment year and subsequently. So this is an impact which is on ongoing M&As. And Arvind, you want to talk about that?
Yes. So I think clearly, again, you thought a matter was dead and buried, that you could rely on the existing jurisprudence. Here again, have a situation like in the case of 45A, where effectively after 10 years of a Supreme Court ruling, and you have a certain stated position being taken out of the statute. The concerns also are there are many companies, life sciences, pharmaceutical companies that have huge goodwill on their books. Now, what happens? Clearly, the way in which valuations have to be done, always done, keeping the tax game in the loop. So, furthermore, it becomes important because otherwise it becomes a net cost. So, concerned with this amendment, what would happen to the pay to working which are already there? There's a concern on appeals where goodwill is being disputed.
Okay, so just to recap, initially we saw a number of administrative changes, the reassessment procedure as well as the AAR and ITAT and so on. Then we have gone on to technical issues such as slump sale amendment, transfer of capital asset and goodwill not depreciable. The other interesting change is again a technical issue which has been decided by courts in favor of the assessees and now being addressed by this budget. So in the case of charitable trusts, the memorandum talks about corpus donations are exempt, and at the same time, the application as part they are claimed as application, and they are worried about instances which have come to their notice of these cases. It also said that entities taking loans or borrowings and making applications for charitable or religious purposes out of these proceeds. And then when again it is repaid, it's again claimed as an application. So essentially they are saying these are double deduction cases. And also end result is there may be a paper loss wherein the expenditure exceeds the income and it's being carried forward by the associations in case of charitable institutions. Now, to attack all of this in one go, they have made a number of amendments. They have essentially made 3 amendments. 11(1)D, basically voluntary contributions which are made with a specific direction that it shall form part of a corpus shall be invested or deposited in one or more 11(5) prescribed modes. So essentially, we always know that the corpus donations which are being made for a particular purpose or specific direction, right? These will now have to be invested or put in 11(5) prescribed mode. Now, the application out of a corpus will not be considered as application of income for a charitable or religious purposes for the purpose of 1023C and 11AB. Now, the other thing they have done is similarly application from loans and borrowings shall not be considered as application for charitable or religious purposes. They have introduced explanation 4 below section 11(1) for the purpose of this. Now, the other thing that they have done is the third limb they've attacked is essentially the computation of income required to be applied or accumulated. No set off of deduction or allowance of any excess application for any of the years preceding the previous year shall be allowed. Now, this amendment is effect from 2022-23, and essentially to again highlight, this has overruled some of the decisions which were there, such as gem jewelry, wherein it was held that in case of a charitable trust, the excess of expenditure of income will be allowed to be carried forward and set off against income of subsequent years. Now, the voluntary contributions which are made for a specific direction and will be forming part of a corpus has been an age-old tradition that you take many institutions which will have. Now that they have to be essentially separately kept under 11(5) and their application will not be allowed is a new change from this finance bill. And we have to see how this pans out. The next one is an obvious one, which is removing difficulties faced by the taxpayer. 234C has exclusions for capital gains in 224(9) because you cannot essentially accurately determine the advance tax liability because of the nature of the income. Obviously, dividend income is the same. We cannot predict the dividend income, and so 234C shortfalls would not make sense. This was actually suggested by the chamber, pointed out by the chamber too, and we see this removal of difficulty being appreciated in this finance bill. The other interesting amendment that we wanted to highlight was the payment by employer of the employee contribution. Now, a lot of you know there are a number of cases such as Delhi High Court as well as Madras High Court, which basically says the late deposit of employee contributions, but even by the employer, is fine as long as it's before the due date of the income tax return. And they essentially said 43B and read alum exclusions and held it to be retrospective and curative. And so this whole set of cases which were there effectively said both employer and employee contributions, as long as they were before the income tax return dates, that is fine and allowable. Now, the interesting thing here is not everybody expected that there would be some change here, and an amendment has been made to say the purpose of determining the due date 43B will not apply to 3615A, which refers to the employee contribution which the employer pays to the deposits to the PF. Now, the interesting thing here is not all that. These are obvious changes. But the interesting thing is it says the amendment says deemed to never have been applied for the purpose of. And explanation 5 was introduced has been introduced in 43B, which says the section deemed to never have been applied to a sum received by IC from any of his employees. So this seems to be having a retrospective language. And it seems we have to see how this is going to play out, because this never to have applied is against the principles of this government, which said that they will not do retrospective. Also, curative provisions only should be retrospective and not these kind of provisions. We have to see, and it will be probably litigated on. Let me move on. I don't know how much time I have. I think let's wrap up in 5 minutes. So the TDS and TCS on non-filers are at higher rates. It's an interesting provision in 206AB and 206AC. And essentially, the TDS and TCS, similar to 206A and 206CC, which are talking about no PAN, there is also non-filers who seem to have some threshold of TDS or TCS. And these amendments are from 1st July 2021. There has been some clarification with respect to the equalization levy, and I don't have the time for that, but basic idea here in the equalization levy is that this was a tax on digital transactions, essentially by non-residents provided to Indians, and it was quite significantly expanded in Finance Act 2020. The ridiculous part of it was not there in the Finance Bill 2020, but found itself in the Finance Act 2020, surprisingly, and it expanded itself to quite a bit by saying that IP address will be used to figure out how this transaction is. But the biggest problem was whether intra-group services. So suppose the headquarters is supplying IT support or supplying equipment, etc., via an online portal. So an American headquartered company, an Indian company goes ahead and uses that online portal, whether these intra-group services would be also coming under equalization levy. Unfortunately, there were a lot of clarifications asked for, but unfortunately, the amendment is going the other way. The amendment actually makes it much more wider. In fact, it says the online sale of goods and online sale provision of services, acceptance of offer for sale, placing the purchase order, accepting a purchase order, payment of consideration, supply of goods, partly or wholly. And so this essentially defines it in such wide terms that almost everything will now come into play. And it also says the e-commerce operator, irrespective of whether he owns the goods or not, and the provision of services, irrespective of whether it's provided or facilitated by the e-commerce operator. So these are opening up a Pandora's box of litigation as well as interpretation issues with respect to equalization. It has not made the issue better, it has made the issue worse, unfortunately. So, Arvind, do you want to say anything about equalization levy?
Yeah, no, I just want to say that clearly, I think in the current times, we are seeing coming in through, we are seeing rather transactions being generated through YouTube-led content, and that's where they also seem to have mechanisms where a transaction which otherwise not involved, not directly, are also being brought in by these direct provisions, where an online payment could also trigger an equalization levy. I think while there is a trade deal with the US which is currently being negotiated, which is stuck, there have been some retaliatory measures that have been proposed. I think this is a very bold move. So while it affects a certain class of SSC, it also shows assertiveness of the government to say that if you are earning income in India, while they actually be making losses, he would have to tax you pending the negotiations by the OECD, finality to these provisions.
Yes, the other couple of things I'd like to wrap up with are one of the things which have been talked about quite a bit in the press is that employee contribution beyond a particular threshold, the interest on it is going to be taxable, and that is exceeding 2.5 lakhs in a previous year in a fund is going to be taxable. Now, with this would hit high income salaried people, and but the finance minister came out and said it's just 1% of the total subscribers. But I do think that in 2016 budget, the interest accrued on 60% EPF tax proposal was originally there, and then it was dropped after hue and cry. I don't think the hue and cry are going to be affecting it this much, because it's going to affect a higher income threshold, and it will not affect people who are contributing up to 20,833 a month to PF. But the new wage code is going to have a higher rejig, salary rejig of basic salary, and so it will lead to a higher PF contribution. But the fact of the matter is, this amendment, I think, is likely to sail through. The other interesting thing I wanted to cover is that their circle rate increases with respect to real estate home sellers. So 43CA, right? And also to home buyers with respect to 56 to 10. The SAPR rate increase is pretty significant with respect 20% deviation can be there. So the guideline value and the consideration value will be a 20% deviation, and that will also be applied. And this applies only to 43 CA and 56 to 10, the receiver and the seller of real estate units, of home units. And so this is essentially to kickstart the inventory which is there for real estate and try to kickstart that industry. So this is a welcome move overall. And I would try to last two are the reduction of time limit for assessment. It's pretty surprising. So they are saying that the time limit for completing an assessment is proposed to be 9 months from the end of the assessment year in which the income was first assessable. So we are going to see quicker and quicker computer process assessments, and we'll see where this goes. It's all going to be faceless and hopefully not spineless. The other final thing I'd stop with is that there's this thing of senior citizens who's age 75 who has pension income and no other income, and he can also have actually interest income from the same bank, and they don't need to file a return. I think we are moving to a regime where more and more details are going to be pre-filled, and we are also going to be just faceless robots and just clicking on the submission for the income tax return. Overall, my take from the budget is that this tries to introduce new regimes, especially the reopening regime is a little worrisome. This whole idea that new is better, different is all better is not a great idea. But on the whole, I think that's where we are moving to, the entire digital faceless assessments. And so we are going to see a lot of changes on the procedural aspects as we go further and further, and we have to see how that goes. With that, I complete. Arvind, you can step in forward.
Yeah, I'll just take a quick 30 seconds
Yes.
before Sriram gives his overview. I think quite clearly the government is trying to see how the learnings in the GST in terms of GST and implementation is being brought in. That's why you have punitive measures of withholding tax. Clearly, the exchange of information that's happening. So they're setting up a similar kind of system for direct tax provisions as well. I think the real compliance burden, what was stated was we'll try and bring down compliance, but we're actually making compliance a nightmare. And some of these provisions like reassessment, changing past positions, also there's a subtle aggression which is coming out clearly from these provisions. And that also seems to powers to the department to say that we're backing you, and a lot of these provisions are cherry-picked provisions. So when you see tax policy for a mature economy, these work on administration, they work on predictability. When you cherry-pick provisions and when you bring them after you thought like a quill, it was cast in stone. That's again a concern when we're looking at foreign capital coming in. They want predictability, they want stability, and mechanisms for alternate dispute resolution within the Indian law. And when you're taking away a mechanism which was functioning well 10 years back, the authority purpose ruling, I think it really needs to be seen how the taxpayer charter actually find it being operationalized in a true sense. Over to you, Sriram.
Thank you.